This one simple strategy has consistently made me over $100,000 a month day trading without blowing accounts and wasting years on strategies that don't work. And in this video, I'm going to review exactly how this boring strategy allowed me to travel the world, consistently earn six figures and stack profits month after month. So make sure to stick around until the end to understand each step and how you can use this strategy as well. Let's get into it. I've been trading this strategy for 2.5 years, and the reason it works so well is because unlike most strategies out there, it's built on simplicity, precision, and consistency. And most traders lose because they're usually doing way too much. Some people try to trade too many pairs. Imagine you're a student or you work a job. How do you want to look at 5 pairs at once? You're gonna miss so many setups. Some people overtrade. They take too many setups because they're way too impatient to wait for their ideal setup, or they don't even know what their ideal setup looks like, so they take everything they feel like taking. Some people use too many confluences as well, which makes their strategy appear once every 2 weeks, because of course if you have a strategy with 7 to 8 confluences, it's not going to appear as often as the strategy with 3 to 4 confluences. The reason why so many people use too many confluences is because they think it gives their trades extra confirmation, which is not really true. My trading strategy is the opposite of that. It's minimal, focused, and removes all the noise, and that's exactly why it works for so many people. So the only pairs I trade with this strategy are Euro USD and GBP USD, just because they're two of the biggest 3 forex pairs out there. I mainly traded during pre-London and London session, but if you're wondering if New York session is tradable as well, yeah, I got a lot of students who are only able to trade New York session and they're still getting good results. I personally go for 1 trade per day max with this, and I always follow a fixed 1 to 2 risk reward for every trade, which just means I'm looking to make twice of what I'm risking. So if I'm risking $100 on a trade, I'm always trying to make $200. And if I'm risking $1,000 on a trade because I have a bigger account, then I'm looking to make $2,000. My strategy is entirely based on liquidity sweeps and fair value gaps, which is just another word for imbalances, and this is supposed to be the liquidity part, so I'm only using liquidity and imbalance for my trading. I follow these steps every day to earn consistent profits. So let me show you exactly how you can implement it into your routine and actually start earning. So step number 1 would be identifying liquidity on the 15-minute time frame. So for liquidity, we only use the 15-minute time frame. We actually want good liquidity, and how we define good liquidity is by looking at how the liquidity looks like. So if it looks like this, like 2 candles standing out, then it is good liquidity. There's liquidity everywhere in the markets because, in my personal opinion, that's just where price goes to every single time. But we want to redefine what liquidity we use for our trades, and like we strictly go for liquidities which are formed by 2 to 3 candles and they're standing out. So here you can see this is a high bullish candle followed by a bearish candle, and it's standing out. And that it's standing out, the fact that it's standing out makes it buy side liquidity. And since it's shaped, okay, I can mark this out here, but since it's shaped so good, it makes a good liquidity, and it's only, you know, formed by 2 candles. This move that swept this liquidity created liquidity as well because it's 2 candles standing out, and that's also pretty good liquidity. Here's some more examples. So here you can see, you know, 2 candles standing out. I prefer this liquidity over this just because the bodies here are way bigger as well, and they're actually standing out and not, you know, very close to other wicks. Here you can see this wick is close to this liquidity and these wicks as well, but this is valid liquidity. And here you can see as well, the move that swept this liquidity created again liquidity, and this is looking very good. So you see this bearish candle followed by bullish candle forms a low. Since it's standing out so good and there's no wicks and candles near to that, this is a very good liquidity to use. And here as well you can see we had 2 draw on liquidities, you know, again 15-minute time frame only. These 2 candles standing out, liquidity. And here in this case it's 3 candles, like 1 wick as well, but they're also looking pretty good, standing out. You know, they form like a whole move. You can just think of it like spikes. So these are like whole spikes standing out and forming liquidity. I'm going to show you some chart examples after this as well. So we want our liquidity to be obvious swing highs and lows on the 15-minute time frame, and once we see them, we just mark them out and put TradingView alerts on them, and then we just wait until price reaches those liquidity levels and we get notified by our TradingView alert so we can get on chart to check it out. You know, here you can see on my chart as well, this I would say is pretty good liquidity. You know, these 2 candles standing out, and this whole move is forming the liquidity. So yeah, it's good liquidity. Also these 2 candles forming liquidity, and these 2 as well, or we could say, I mean, this is also liquidity, but this wouldn't be liquidity. Why? Because yeah, these are like, this is a low and this bearish candle followed by bullish candle, they do form a low, but it has candles right next to it, you know, this wick right next to it. But the main thing is just, you know, these candles right next to it, which makes it not stand out. And you know, these two candles, this liquidity is forming and standing out, this is not. You know, with how I identify liquidity, I'm not saying the other liquidity points, like I don't know, this might be liquidity as well, like this whole thing, or I don't know, where do we have else, like where else do we have liquidity? This whole thing might be liquidity as well, but it's just not as good as these clean liquidities that we use. For example, this also is probably liquidity, but it's just part of our confluence and confirmation on the trades, and also, you know, that we don't get any false alerts and false like fake out setups. So once we see our liquidity, imagine this is your trading day, and you know, you just wake up and mark out this liquidity, and this is from, you know, London session open. So you mark out this liquidity, and then a couple of hours later, price comes and, you know, you have your trading view alert on it, and price comes and triggers your alert. What do you do then? That's step number 2. You confirm the sweep by going down to the 1 minute time frame, and on the 1 minute time frame, you want to see a clear change of direction, the COD. So you want to see, you know, we have this liquidity, and you want to see price come up to that liquidity, but instead of price just continuing to the upside, you want to see a change of direction. And how we see that change of direction is by seeing a imbalance while sweeping, or right before. It shouldn't be created right after. So we have this fair value gap here, this imbalance, which I already have marked out, and it was created during the sweep of this liquidity, so it's valid to use. And for our change of direction to be complete, so you know, to confirm the change of direction, we want to see price come and close below this imbalance now. And in this case, you see we had this imbalance here, you know, instead of going up and continuing and, you know, it being a takeout, so that would have been a takeout and not a sweep, we waited for, you know, price to come down and actually close below this imbalance, which it did right here, and that would have been the entry signal. So that's step number 3, the entry. And the entry is simply done where we get the inverse of our fair value gap. So now, you know, there's supposed to be a fair value gap during or before the sweep. For example, we had this fair value gap before the sweep happened as well, but if we had waited for that fair value gap to be inverse, which happened right here, we would have had a stop loss placement of 5.4 or even, you know, 5.8, almost 6 pips, which we don't want to have, because we only want our stop loss placement to be offered at 1.6, like something around 1.6, shouldn't be way smaller than this, and something around like 1.6 to 4.5 shouldn't be like way bigger than 4 pips. That's the optimal stop loss size offer we want to have. So, you know, if we had entered right on this candle, we would have had this stop loss offer, because we want to place our stop loss always on, you know, on the bodies of the new liquidity which is created, you know, of this whole new move of the sweep, or, you know, it could be on the wicks as well, but I prefer doing on the bodies. The sweep line can also be used, you know, the liquidity line can also be used as stop loss, but here in this case, you see it would have been way too small, so you just put it, you know, with a decent 3 pip stop loss. You know, 3 pips is very good for a stop loss, because you then target for like around a 6 pip TP, which is clean with the 1 to 2 risk to reward. And there's also a couple of things that can make your trade riskier, so, or, you know, completely invalid as well. So if price comes up and, you know, it goes up like this, and then someone creates a fair value gap up here and then inverses it, look where the fair value gap and the setup was created here, you know, in our case, and look where I've drawn it. So this is around the sweep and around where the liquidity was. This is way too far. So this is a very deep sweep. That's so-called deep sweep, you know, where we change the direction way too late after, you know, actually going through that liquidity and triggering our alert. So we want to see our setup happen, you know, pretty quick when the sweep happened, and, you know, in that area of that line of that sweep, so we don't get invalid setups and we don't take them, because that's almost like, you see how far it went above the liquidity. It's almost like a takeout and not a sweep anymore. Another thing you might, want to be aware of is that fair value gap size matters as well. So if this fair value gap was, I don't know, this big, you would have to wait for a closure, a candle closure below this big of a fair value gap, and that happened. All right, if we are strict, then it happened here, and you still could have had your a stop loss offer with 4.5 here. So if we do enter here, but let's say it was, I don't know, this big, then you would have had your entry here, your stop loss way too big to even get this trade, so that's invalid. So yeah, like too small for value gaps are not really a big red flag, or are not any red flag at all, but too big for value gaps are a red flag definitely, because they make your stop loss offer way too big. Like you want to wait for the fair value gap to inverse, and if the fair value gap is too big, the inverse is very late, so you get a bad stop loss placement offer. Step number 4 would be having a first TP, and when that first TP is hit, you put your stop loss to break even. So what is the first TP? First TP is just a line, or an alert you draw on the chart. You don't have to do anything on your trading platform. So let's say you enter this trade right here, you put your stop loss there, and you put your TP, let's say, I don't know, here you got your entry here, and then this is your trade now, and right now price is somewhere here. Right after entering this trade, placing your stop loss and placing your TP, you want to put, trading view alert works pretty good. You want to put a trading view alert exactly at 1 to 1.5 of your TP. So this is 1 to 2, and if you drag this right here, you can see 1 to 1.5, and this is where you want to like put a mark, or even better, put a trading view alert. So when that gets triggered, when you get a notification, your first TP got hit, like price reached that level, and now you can just, like, when price goes down and reaches that point and you got a notification, you can put your stop loss from where it was to like break even. So now you're risk free in that trade, and even if price reverses from here and edges your TP or doesn't trigger your TP, you won't be losing any money on that trade, and you're going to be stopped out at break even, which means at zero. For people who keep losing money on funded accounts and are stuck in that cycle, I created the so-called Glory Launch Plus. The Glory Launch Plus is my new program where I help students to get funded or get their first payout by showing them how I would approach funded accounts. You're getting access to my live trade replays, so you can see how I be catching these setups every single day. You get access to in-depth exclusive videos, including psychology videos. You get 2 weekly group calls where you can get your trades reviewed, and you'll also get my personal phone number for 24/7 one-on-one access, so you can get all your questions answered and I can keep you accountable. To see if you're the right match for the Glory Launch Plus, you can apply using the first link in the video description. Now it's time to break down exactly how you can put the strategy in action and finally start making consistent earnings. So how can you use all this to make money? So here's exactly what I would do if I were just starting out. I would go for a 2-step funded challenge. Why 2-step and not 1-step? 1-steps mostly have tiny daily drawdown and tiny overall drawdown, and compared to that, what you have to make, so your profit target, is also pretty big. So they mostly give like 8 to 10% profit target and only 6% overall drawdown. If you go for a 2-step funded, they, almost every prop firm I know, on the 2 steps they give 8 to 10% overall drawdown and 8% profit target, which is great on phase 1. On phase 2, you get 5% profit target, which is even better. So the ratio of how much you're allowed to lose on that account and how much you're supposed to make to pass them is pretty good on 2 steps. That's why I would go for 2 steps. And yeah, you should just go for a reliable prop firm. The ones just came up to my mind are here, the Fivers. I've traded with them. They have a very good spread. FTMO, very long in the game, probably the most reliable one. Or Funded X, I've heard very good stuff about them. Seen a lot of people in my community using them and telling me good stuff about them. Yeah, they're probably a lot of other prop firms as well, like Funding Pips, Alpha Capital. But yeah, just go, I would say probably go for the Fivers, pretty good. And the best sizes I would say to start are 10Ks. If you got funds but it's all right, like 10Ks are like, I don't know, $80 to $100 to start, pretty good. If you don't have thousands for trading, if you do have thousands for trading, you might as well go for 100K. Make sure that you actually know how to use that strategy, how to spot it, through back testing, through forward testing on demo. But I wouldn't stick around demo too long, because if you actually know the setup, if you actually know how to use risk management, you might just as well trade on a funded account. Yeah, whatever size you go for, 10K or 100K, make sure the account you go for, you're actually ready to lose and you're comfortable to lose it, because you might, like, nobody's guaranteeing you that your first funded or the next funded you're gonna try is gonna be 100% profit target hit and 100% pass, but you know, out of probability, you can blow those as well. Phase 1 and phase 2, you're gonna stick to 1 or 2% risk per trade. That's the risk management part. And why I said 1 or 2 is just because if you want to go aggressive, if you do have funds, you might just go for 2% risk per trade. If your, I don't know, propfirm allows it as well. I know for a fact that Funded X only allow 1.5% risk per trade, and they only have like a 1 to 50 leverage, which doesn't even allow you to risk 2% on these scalping trades, you know, on small time frames. So if you're with the Fivers or FTMO or, you know, any account which gives you 1 to 100 leverage, you could go for 2% risk per trade as well. But the main thing is, whatever you start with, you're going to keep continuing with that. So if you start your account, if you start trading it, if it's a fresh 10K and you start trading it by risking 2% per trade, so $200 per trade, then I would stick to that as well. And I wouldn't switch trades in between, because that might mess up with your psychology as well. But yeah, if you want to go with decent risk, like I believe 1% is pretty good and is all you need to actually long-term become profitable. It just might take a little longer to pass, which is good, but you could go aggressive as well if you're comfortable with that. And for phase 2, you only have 5% profit target, mostly on 2 steps, where I also would, even if you started phase 1 with 2% risk, on phase 2 I would probably go for 1% risk, because phase 2 is very close to actually getting funded. And it's not a psychology thing for me, but it's just like strategic. So if you do go for a 2% risk on phase 2 and you get like a little losing streak of like 5 trades consecutive, your account is gone and your chance of, you know, almost being funded is gone. You might have went for a 1% risk for that account to last longer as well, since you're already very close to getting funded. So yeah, just, you know, it's just way smarter to, whatever risk you started with phase 1, on phase 2 it's smarter to go for only 1% risk per trade. And then of course, when you're funded, so once you're funded, drop to 1% risk per trade to secure consistent profits. On the live funded, you know, after phase 1 and phase 2, I would never go for more than 1% risk per trade. You're still gonna have, you know, 1 to 2 risk reward, which gives you 2% per win. I personally believe if you over risk on trades on live account, you're probably just, you know, very greedy. You don't really have your psychology and your emotions in control. So make sure you don't blow that live account by just chasing, you know, big returns and try to rush the process of making money. Risk management is like key, because you can, you know, build profits, build yourself up, build an account up, maybe almost about to pass, almost about to get payout, I'm almost about to pass phase 2 and get funded, but using the wrong lot size and, you know, over risking or something, it might be over risking and, you know, using the wrong lot size once only, but it can wipe all your wins. Of course, you also don't want to have too small lot size, because then you're under risking, which, if you do get wins, the wins are not going to be as big as they're supposed to be. So basically, good risk management is the difference between gamblers and traders. Gamblers don't really have risk management, traders do. So let me show you a quick example how you can calculate your lot size. If you're, let's say, on a 100K account, on the 10K, it would be just divided by 10, everything here. So you're on a 100K account, you're seeing a trade right now, and it has a 2.5 pip stop loss, which is 25 pips, because 1 pip is 10 points always. Yeah, you want to risk 1K on that trade now. And what you do to calculate your lot size, so in those 25 points of your stop loss, you don't lose more than $1,000 what you want to risk. What you're going to do is you're going to divide the amount you want to risk, which is 1,000. You're going to divide it by 25. So divide it by the points, not the pips. If it's a 3 pip stop loss, you're going to have a 30-point stop loss. So the points are important in your risk management, in your lot size calculation. So 1,000 divided by 25, because it's a 25 point stop loss, and that's going to be 40. So that's just basically your lot size. So if you now open the trade with 40 lots, if stop loss hits on that trade, you're going to lose $1,000. In that case, if you wanted to risk 2%, so 2K instead of 1%, which is 1K, you would just have to use the 40 lots 2 times, so 80 lots. because now you want to risk 2,000 divided by 25, which is 80. And that's the exact boring trading strategy which I use to generate over $100,000 per month. Now, if you're serious about taking your trading to the next level and you want to learn the best methods that top traders are using, click the first link in the video description to apply for the Glory Launch Plus and see if you're the right match for it. Thanks for watching.